My name is Hunter Lewis, and I am from Grand Valley State University. The most exciting aspect was taking the company from the ground up and valuing them throughout the entire process using real-life business valuation techniques. Well, I wasn't really sure what to expect at first, but I tried to assume the worst, and it was actually a lot more challenging than I expected. But that was a good thing because it gave me some exposure to the real world. It definitely exposes me to the valuation side of company analysis, and that's something that I'm really passionate about, and this just furthered my passion and allowed me some more exposure. Definitely it was a little bit slower and a little more time consuming than I would assume it would be in the real world, but being that it was my first time taking a company from this type of valuation, I think it was a fair assessment of how it would be in the real world. Good morning. We are Seedman Equity Research of Grand Valley State University. My name is Hunter Lewis, and these are my colleagues.
Tim Helpin.
Eric Curtis.
Nick Curtis. We are initiating coverage on Herman Miller with a buy recommendation and a 12-month price target of $25.92. In the coming 12 months, we see two main catalysts for growth. One, the acquisition of Posh Furniture Systems, which has an already well-established dealer network of 25 dealers in China. And two, the use of a truly variable cost structure that will continue to widen margins. This is the Herman Miller Performance System, and it's unique to Herman Miller. Herman Miller is a contract office furniture company that's primary line of business is the research, design, manufacture, and distribution of office furniture and related products. Their fiscal year 2011 revenue base was 14% from the U.S. government, 24% from home health and education, 23% internationally, and 39% from the U.S. office industry. They operate through 740 dealer locations worldwide, and 250 of them are located in North America. And now my colleague Joachim will talk about the valuation.
Yes, there are three key factors that will drive growth and free cash flow. First one is revenue growth. Going forward, Herman Miller is generating 20 to 25% EBIT margin on organic revenue above the $1,650 million achieved in fiscal year of 2011. Secondly, capital expenditures will stay minimal because Herman Miller is running at 55% production capacity utilization. Thirdly, free cash flow to revenue yield is 3.85 currently, and however the Herman Miller 8-year average has been around 9.54%. We expect this to reverse to the mean, and this is also supported by the fact that the current free cash flow is depressed due to a payment to reduce pension liabilities. We evaluated Herman Miller using a DCF analysis, sum of the parts approach, and the average of 4 multiples. We weighted both methods equally, and this gave us a target price of $25.92 per share. For our multiples, we chose Steelcase, H&I Corp, and Knoll as the peers to compare Herman Miller to. They're all similar in size, markets, and location operations. And the 4 multiples we used were the S&P 500 10-year price to earnings, and pure enterprise value to EBITDA, the pure price to earnings, and then Herman Miller's price to its average 7-year earnings. This gave us a average target price of 26.25. For DCF, we separated the different markets and assigned an individual growth rate. We evaluated also Posh independently, and then we combined their share prices together, and they gave us a target price of 25.6 per share. And all our assumptions are also outlined in our analyst report. For financial analysis, we focused to analyze the risk of permanent loss of capital and also non-cash working capital's effect on future free cash flow. Our Altman Z model gives us a result of 4.8, which is a healthy ratio, and it's also equal to an implied debt rating AA. We evaluated Herman Miller's financial reports for earnings manipulation. We evaluated the likelihood of them doing so by the B&M model. Herman Miller easily cleared the model's benchmark, and we found no evidence of manipulation in their statements. So our conclusion for that is that there's a low risk of permanent loss of capital by investing in Herman Miller. Herman Miller's non-cash working capital has been 1% for the 7-year average. However, the last 3 years has been running around 2.5%. So in our DCF model, we chose to use a conservative number of 2%. and also the ability to reverse to the 1% as revenue increases. Lastly, we chose to use sensitivity analysis using a reverse DCF model to illustrate the different growth assumptions and the price they would give and the impact on Herman Miller's share price. So the first scenario is a zero growth scenario for 10 years and a 3.5% growth in a terminal growth rate. That gives a target price of 17.12, which represents a 20.44% downside to Herman Miller's current price. Our second scenario is a scenario that follows the US GDP growth, 2.5% for an ongoing time. And then that gives us 21.31, which is a 1% downside. Lastly, our last scenario is the current market price of February 3rd closing price of 22.82. They applied the assumptions and growth at 3.5% for the first 5 years, then 3% for the next 5 years, and then 2.5% for the terminal growth rate. And our conclusion is that first two scenarios are highly unlikely to materialize, and therefore it also shows the limited impact Herman Miller's limited downside Herman Miller's share price has. And now my colleague Tim will continue the industrial analysis.
All right, when we started this, we wanted to make sure that the numbers that BIFMA, the trade organization for the industry reports, as you can see, we took the peer group from Yoakum, and then we added CIX for 5 companies. We found the standard deviation between their growth rate and BIFMA's numbers that they report to be 2.8% standard deviation. So with the sample size of only 5 companies, we feel that that's very accurate and reliable to use. Next, we did a portfolio analysis. We used BIFMA's numbers as the market in each of our companies as its own portfolio. And the upside capture for Herman Miller was 1.09 with a downside capture of 0.83. Also, Herman Miller has beat the industry 71% of the time. Next is 4 graphs of the trends in growth sales and cost of goods sold sales. And here for Herman Miller, you can see in 2002 is when they implemented their performance system. It's so unique to the company. And this chart just shows the averages of those 4 charts on the previous slide. And you can see that Herman Miller is only one of 2 companies that has outpaced their growth in cost of goods sold with their growth in sales. Now I'll pass it on to Eric for investment risk.
So we've taken some of the risks from the most recent 10K along with some of the risks that we've received and put them in this table, demonstrating the likelihood of the event and then the impact on the company should the risk happen. One of the most likely risks we see the company facing is a sustained economic downturn. This is possible due to Eurozone debt and deficit levels being well above those acceptable as per the Stability and Growth Pact. And as of yet, we've seen no punishment for violating these requirements. As a result, Herman Miller did lose some top-line growth. However, as was seen in fiscal year 2009, the company is able to maintain a very healthy bottom line even through far worse economic downturns. And as Yoakum mentioned earlier, our DCF models were built with a very conservative growth for this very reason. More concerning are the lower interest rates we're seeing as a result of this downturn. Herman Miller has defined benefit pension obligations in excess of $375 million, which are currently underfunded by about $42 million. Herman Miller's management has indicated a high aversion to any further capital erosion, as was witnessed in fiscal year 2008 to 2009, when the fund went from $23 million to $120 million underfunded. Therefore, management would like to focus more on fixed income. However, with fixed income yields relatively low, it is possible for pension obligations to grow faster than these new returns. However, management has done a great job managing this risk. Beyond the $50 million that they contributed this fiscal year to ease that liability, the fund gained an additional $20 million just through capital appreciation. Now Nick will talk about some more investment risks.
Since Herman Miller does not participate in hedging commodities, increasing steel prices is a risk they will most likely face, but one that will not have a material impact. As you can see, over the past 9 years or so, Herman Miller's margins have been relatively unaffected by these price movements, thus suggesting their ability to pass these price hikes off to customers. Second is a delay in the Posh acquisition. We see this scenario as a rare likelihood. However, any delay would negatively affect our growth projections and would limit Herman Miller's ability to fully utilize distribution assets in Southeast Asia. Finally, it's a self-insurance risk. This imposes potential major implications to their financials if a claim would ever be made that was above their predetermined retention level. However, once again, we see this as a rare scenario. So my team and I at Seaman Equity Research believe that all this analysis supports our investment thesis for recommended buy with a 12-month price target of $25.92. Thank you. That includes our presentation. Is there any questions?
One of the premises in your story is the ability to grow in China. The Posh acquisition is a pretty small acquisition. It's a pretty small part of their business. What is the anticipated growth rate for that initiative? I guess that.
And so we assume a 9% growth rate, which is equal to the GDP growth rate in China. Also, a lot of the industries in China now are moving more to office types of things. In Shanghai, all the East Coast, Guangdong Coast there, a lot of employees are coming into cities, and they're also moving into offices. And there's a massive construction in office for the space area. So we see furniture being a really important area in China now, and that's going to keep also strong growth in that industry there, and that's something I'm going to be able to.
Will that give them manufacturing operations in China?
They already have one in Ningbo, China. So we also believe that they have already streamlined their manufacturing with the Posh, so they can keep their margins and a strong growth
So
rate.
the Posh acquisition is primarily for distribution?
Correct.
Do they have any supply chain issues with what we've seen happen with Toyota over the last year between what's, floods in Thailand and then the earthquake in Japan? They talk about their supply chain management being so lean. Are there issues that they could have supply chain disruptions that would affect their ability to supply product to domestic markets or international markets?
I'll go ahead and take that question. Most of their supplies are sub-assembly based, and a lot of them are based here right in Michigan. For the Posh acquisition and their distribution centers there, they do rely some on the sub-assembly suppliers here. So it's primarily based here in Michigan, and there's not much risk of a catastrophic event here. So that's not too much of a risk.
In your analysis, you talked about you would assume different growth rates for different markets. Talk a little bit about the government market and your assumption there going forward.
Yeah, we assume the government market is going to be reduced. We don't have it as a separate market. We expect healthcare to grow at a faster rate than we assume our analysis, and that will also offset the downturns in the government market.
You make a comment that you thought cash flow would return to mean why? What's the catalyst? What will make it return to mean?
As revenue increases, Hermel is able to leverage their variable cost structure, and that will also enable them to grow their margins on EBIT. As they're going forward, they're generating 20 to 25% EBIT margins on organic revenue, and as revenue increases there, free cash flow will come up to the mean. And also, the current free cash flow is reduced to a one-time occurrence payment to reduce pension liabilities.
If I've got a buy in the stock right now with a price target of 25, can you give me an idea of where you see the stock as being value? We've had a great run. We've had a great run in the stock so far this year. But what would be a price target and a valuation that you guys would say we need to take some chips off the table on this one?
Yeah, depending on the variables that comes into play, depending on margins and so on, and the revenue increase. If there's any faltering in the margins and so on, and price starts to increase, and you get to about a 16 PE ratio, I would consider just going back on the amount you have in Herman Miller, depending on also the overall economy.
What's the valuation relative to it? I think you have 4 competitors. So on a relative multiple basis, PE multiple, what is their multiple relative to the competitor?
Herman Miller and Knoll has the lowest multiples. Knoll is a few basis points below Herman Miller, but Steel Kitchen and H&R Corp is much higher than 20 multiples, while Herman Miller is in the 14, 15 multiple right now. Same with Knoll. So that's the difference in there, and we believe the growth rate that will achieve it.
Has that historically been the case, where they've had a lower multiple than
No, they have been in 20 multiples for in the mid-2000s, but due to the last financial crisis now, they had been in the lower multiples. I think the lowest multiple was around 9, and then it's been increasing somewhat as the risk aversion has been declining in the oil markets.
So why then do you, if it was at a 16, why would you sell it?
I don't believe that at that point the company is too much value for the price on it. If it grows in the fundamentals on it, the PE will stay at 16 even though the company grows in value because there will be a healthy growth underneath it. But price earnings about 16, especially up in the 20 and 30s, is not. There's cheaper companies you can get for that price.
The company's moving to more fixed income and their pension, they're going to adjust their assumed rate of return, obviously.
Yeah, their discount rate is currently only at 3.42% due to that more fixed income basis. However, they do sell a lot of that equity from prior purchases, and those are seeing a lot of capital appreciation. So they're not bringing it down too much yet because of that rebound in the capital markets.
Have they frozen the pension plan, and are they moving to a defined contribution plan for the rest? I mean, will this pension liability continue to grow because we've got current employees coming into it, or is the plan to grow?
Yeah, they've made no mention of moving away from the defined benefit. I think that's one of the big things about Herman Miller is the great employee retention, great employee benefits. It really makes them a great company, and they retain talent that way.
Thanks very much.
Thank you.